Amazon stock is down nearly 15% from its 52-week high, and on today's episode, I want to explain where it could be in the next 5 years. First, let's take an introduction of Amazon and why it matters. Amazon is more than the world's biggest online store. It marries three global platforms: e commerce, cloud computing, and advertising inside a single ecosystem held together by 200 million plus Prime subscribers, a dense logistic network, and proprietary technology. That mix creates powerful network effects. Each additional Prime user or third party seller deepens Amazon's data trove, lowers per unit shipping cost, and boosts ads relevance, reinforcing its lead. In short, Amazon offers multiple growth engines but must execute flawlessly to keep them all humming. Now, let's look at recent performance with their recent earnings. On Q1 2025, highlights a picture of steady top line growth and improving profitability. Net sales were up 9% and it did beat guidance. AWS was 29.3 billion, up 17% and is still the profit workhouse. Ad revenue 13.9 billion, up roughly 18% and is outpacing peers. Operating income 18.4 billion, and margins were up to 11.8%. Now net income of 17.1 billion, up 64%, continues to show some great results. Now, unfortunately, trailing 12 months free cash flow was down 50%, mainly driven by huge capital expenditure. Now, AWS delivers roughly 62% of total operating income, and it is a 40% margin segment. This is insane, especially as this market continues to grow. So now let's understand the overall markets Amazon is in. E-commerce, global online retail hit about $6 trillion in 2024 and is forecasted to grow 31% by 2028. While e-commerce share of total retail is rising from 19% in 2023 to roughly 22% in 2027, US competition is intensifying as Walmart, Target, and Costco turn thousands of stores into mini fulfillment hubs. But Amazon still owns roughly 40% of domestic GMV and continues to expand abroad. Now, if we look at cloud computing, enterprise spending on cloud services reached 94 billion in Q1 of 2025, up 23% year over year. AWS, Azure, and Google Cloud control roughly 63% of the pie, but AWS shares has slipped from 33% to 29% in 2 years as Azure and Google outgrow it. With roughly 85% of IT spend still on premise, secular tailwinds remain strong, but pricing and innovation wars will be brutal. Now, the digital ad market is a follower user intent, and digital ad dollars follow user intents, and Amazon's retail search data is gold. Its ad unit is now the number three global platform behind Google and Meta, growing 19% year over year. Now let's look at the bull case, and there are about five pillars of optimism. First is AWS as a multi-$100 billion franchise. Even at mid-teen growth, AWS could double its revenue this decade if cloud penetration flips as CEO Andy predicts. Scale economics plus proprietary silicon keep segment margins near 35 to 40%, funneling cash to the parent business. Next is the advertisement flywheel. Sponsor product and video ads monetize existing traffic, so every extra ad dollar is largely profit. As groceries and apparel categories deepen, brands will pay more to first party purchase data that Google and Meta can't match. Next is retail efficiency and optionality. One day and growing same day delivery densifies routes, raising throughput per truck and per warehouse. Next, we have new ventures, healthcare, a logistics as a service, and buy with Prime for external sites could tack on high margin fee revenue. Next, we have reasonable multiples for a mega cap. Forward PE of 36 and price to sales ratio of 3.4 sit at the lower end of Magnificent 7. Finally, we have innovation AI upside. Investments in generative AI chips, Alexa super agent, self-driving Zoox shuttles, and Project Kuiper satellites create long data call options most retailers lack. Now, the bear case, and there are about five warning flags. First is AWS deceleration and margin risk. Growth has slowed from 30% to 17% year over year. If Azure or Google keep symphony workloads, AWS shares and premium pricings could erode. Upcoming AI capex can also depress cash flow and margins. Next is the knife edge of retail economics, which is already ultra low margins, and any shocks can flip profits to losses. Things like wage hikes, unionization, fuel spikes, higher return rates, and the list goes on and on. Walmart's store footprint also lets it match Amazon on speed at potentially lower last mile costs. Next, we have regulatory overhang. US FTC and EU antitrust cases could force changes to buy box algorithms, curb private label self preferencing, or even push for structural separation. Next, we have free cash flow compression. Trailing 12-month capex of $93 billion nearly doubled year over year, slashing free cash flow 50%, and persistent heavy spend could weigh on shareholder returns in a higher rate world. Finally, is execution complexity. Running groceries, Hollywood studios, rocket launches, and cloud simultaneously risk managerial dilutions. Next, let's look at one metric that all investors should focus on, and that is AWS, especially the overall operating income, as AWS generates roughly 50% of operating income. So one should focus on the revenue growth trend. A reacceleration to 20% plus would confirm renewed cloud momentum. A slide toward low teens could amplify share loss or pricing pressure. And overall, this can create some form of instability in margin. So we want to make sure that the AWS market continues to have a margin stable of at least 35% and more. Now, if AWS can simultaneously grow and stay highly profitable, Amazon's broader thesis remains intact. If not, losses could be in the future. Now, my 5-year outlook. Assumption of revenue compounded annual growth rate of around 11%, retail being mid-single digits, AWS and ads being mid-teens, operating margin expansion of 11% to roughly 14 to 15% as AWS and ads tilt the mix there. Net income could double from $40 billion in trailing 12 months to roughly $80 billion by fiscal year of 2030. Now, my bull case is AI-driven cloud and ad growth push margins toward 17%. Earnings more than double, justify a 20 to 38% multiple, and that gives the stock a $3 trillion valuation, completely outperforming the market. Well, those are my thoughts. Now, are you ready to discover more promising investments opportunity? Visit fool.com/invest to get the top 10 best stocks to buy now. That's it for today. If you found this insight valuable, hit the like button, subscribe for more, and help make our community smarter by sharing your thoughts in the comments below. Stay foolish, and we'll see you next time.